What's up, Mavericks? If you're sitting on home equity, could it be the cheapest way to fund your business? Let's be real, borrowing money isn't always easy. Traditional business loans can be slow, lines of credit can be hard to qualify for, and personal loans can get expensive fast. But if you own a home, there's another option you might not have thought about, a home equity line of credit or a HELOC. In this video, we'll break down how a HELOC works, whether you can use one for business funding, and what risks you need to know before you sign anything. A HELOC or home equity line of credit lets you borrow against the equity you've built into your home. Think of it like a credit card backed by your house. Instead of getting one lump sum, you get a revolving line of credit you can draw from as needed. Your lender sets the limit based on your home's value, and one of the best parts is you only pay interest on what you actually use. Now, HELOCs usually have two phases: the draw period, where you can borrow and repay freely, and then the repayment period, where borrowing stops and you pay down what you owe. Because it's secured by your home, HELOC rates are usually lower than most unsecured loans. They often track the prime rate, so they can change over time, but as you'll see a little bit later, the trade-off is big if things do go wrong. Now, technically, you can fund your business with a HELOC. Most lenders don't restrict how you spend the money as long as it's legal. That means you could tap your home equity to cover startup costs, inventory, payroll, or cash flow gaps. However, not every lender loves the idea. Some may ask what the funds are for or flag business use as a higher risk. If your lender does ask, just be honest. If you're not upfront about how you'll use the funds, you could violate your loan agreement. Now, the key thing to remember: it's your home on the line, not your business. So while it's possible to use a HELOC for your business expenses, it's a big decision that you need to think through carefully. A HELOC can have some strong upsides, but it's not for everyone. Here's what to weigh before you sign. First, rates are generally lower than what you'd get with business credit cards or unsecured loans. You get flexible access, borrow only what you need when you need it. HELOCs often come with larger borrowing limits, especially if you've built strong equity. For some people, qualifying is easier. Because a HELOC is secured by your home, it's often easier to qualify for than a business loan, especially if your business is new or doesn't have a long credit history. And finally, funding is usually fast, sometimes just a few weeks instead of months like SBA loans. But using a HELOC for business comes with a few serious trade-offs. First of all, your home is collateral. If you miss payments, you could face a foreclosure. You also need to consider that HELOCs often have variable interest rates, so payments can rise as rates change. A HELOC also won't build your business credit for you, and during downturns, lenders can freeze or reduce your line if home values drop. While limited borrowing and no business credit benefits are minor inconveniences, the biggest drawback is that your home is on the line if your business struggles. This is high stakes funding, so you definitely want to proceed with caution. If you've built solid home equity, have stable income, and just need short-term, low-cost funding, a HELOC can make sense. It's best for established homeowners who are confident their business can cover the payments, not early-stage startups or anyone living month to month. If you're not sure a HELOC's worth the risk, think about other ways you can fund your business. A business line of credit is a revolving line of credit tied to your business instead of your home. It works a lot like a HELOC, borrow, repay, repeat, but it's based on your business's revenue and credit, not your house. Now, the rates can be higher, but the personal risk is much lower. Then you have SBA loans, the gold standard for affordable business funding, backed by the Small Business Administration. These loans offer long terms and competitive rates. There's more paperwork and longer wait times, but they're one of the safest ways to borrow. If you have smaller expenses, a business credit card could be a better option. They're easy to get, can build your business credit, and often come with perks like cashback or travel rewards. Just watch out for those high interest rates. Finally, if you need fast funding, try options like equipment financing, personal loans, or short-term business loans. Rates may be higher, but they are worth exploring if you need speed or flexibility. Not every option will fit your situation, but if a HELOC feels too risky, you've got plenty of other ways to get funding for your business. If you are thinking about using a HELOC, start by checking how much equity you actually have. Most lenders want you to keep at least 15 to 20% in your home. Next, check your credit score and debt to income ratio. A strong personal credit profile will help you qualify for better rates and higher limits. Lenders usually look for a credit score of around 680 or higher, but some lenders will go lower if you've got strong equity. Then you're going to want to shop around, compare interest rates, draw periods, repayment terms, and closing costs from multiple lenders. Don't just look at big banks. Online lenders and credit unions can be more flexible and faster to fund. Once you're approved, your HELOC works like a revolving credit line. You can draw funds into your business account for things like inventory, marketing, or cash flow gaps. Just remember, it's your name on the line, not your business's. If you're looking for a good place to start, check out Lendtek. Lendtek offers HELOCs through a quick online application, responsive customer support, and access to other business funding options if a HELOC isn't the best fit for you. It's a simple way to compare your choices without spending hours calling banks. To learn more, check out our full Lendtek review linked in the description. Using a HELOC to fund your small business can be a smart move, but only if you fully understand the risks. You're borrowing against your home, not your company. The rates might be low, but the stakes couldn't be higher. So before you tap into that equity, make sure your business plan and your personal finances can handle it. Because while using your house to fuel your hustle might sound tempting, you don't want to end up trading your home office for no home at all. Thanks for watching. I'll see you in the next one, Mavericks.